If you bought a home in the last year and a half, you might be getting a lot of mail to refinance. Well, the beauty of the VA home loan is they have a program called the Interest Rate Reduction Refinance Loan, and for short, we'll call it an IRRRL, as we do in the business. So what an IRRRL is it gives you the ability to refinance your home with minimal paperwork in order for you to be able to take advantage of a lower interest rate. Now, rates are hovering all around, right? Depending if you do buy downs or not, it's all going to have a large spread. We've seen rates as low as 5.25%, but at those rates, typically you're going to have to do a buy down. Now, lenders are going to tell you that there's no costs associated with the loan, and that's because it's rolled into the mortgage. So unlike when you bought a home and used your VA home loan, you had to pay for closing costs. Well, here, this is the only time you're going to actually be able to roll in those costs into the loan itself. Now, the cost of the loan is going to vary widely, right? Depending on where you live. The things to consider are there going to be lender fees? Are there going to be title fees, which you're going to have them, but they range widely. Also, if you have to pay any type of government fees, that can also affect your VA home loan, and is it going to be worth actually refinancing, right? So that cost is going to vary widely. Just make sure that you're looking at a loan estimate for them to be able to at least give you a ballpark of what that cost is going to be. Something else to keep in mind, that if you pay property taxes and your homeowner's insurance, you're going to have to set up a whole new set of those in your new mortgage. So just, be aware that your mortgage balance is going to increase, maybe a little, maybe a lot. I'm not sure because everyone's situation is a little different. But the good part is you're going to get a refund of that money that's in your current escrow account back to you 30 days or so after you've closed, so you can get a little bit of money back. Now, a lot of lenders will also tell you that, you get to skip 2 months of payments. Well, that's not, in a way, yes, you don't make 2 months of payments, but you're not skipping 2 months of payments. Just like anything in life, nothing is free. So what they do is they actually roll in the interest into the mortgage. So between getting your, let's say, potentially saving of 2 months of payments, plus also getting the refund back, you might be left with a pretty penny if you want to do some renovations around the house or whatever the case may be. It's money that you can keep. Now, along with the cost of the loan, there's something else that you got to be aware of. There's also a funding fee associated with these IRRRLs. If you have a VA disability, then you're good to go. You do not have to, you're not going to pay a funding fee. But if you do have to pay the funding fee, you actually pay at a reduced amount, which is 50 basis points or 0.5% is what you're going to pay. Not like when you bought, when it might be over 2 or 3%. They kind of go easy in this case and reduce that to 0.5% across the board. Even surviving spouses as well, if they're refinancing, they will be exempt from the funding fee. Another thing to keep in mind is what can you use these interest rate reduction refinances loans for, right? The type of property and occupancy, let's say. If you bought a property with the VA loan, you can do an IRRRL on it. The cool thing about it is that even if you purchased the property as your primary residence and has now turned into an investment property or a second home, yes, you can still do an interest rate reduction refinance loan on that property, even if you're not living in it. You still get to take advantage of the low interest rates across the board, so that can be enticing. Now, let's talk about the documentation that's required for these programs. It's not going to be anything close to buying a home where you're giving all your pay stubs, bank statements, there's a sales contract, an appraisal, maybe even a blood sample. I don't know. But actually, I do know I do this for a living. You don't need a blood sample. But the amount of documents you typically think you need is just insane. But when it comes to these IRRRLs, it's actually pretty straightforward. What you typically need is a copy of your ID. You need a copy of your mortgage statement. You're going to need the most recent 6 statements and potentially a 7th one. Just kind of depend on where you fall into the time of the year and when you actually purchase the property, which I'm going to cover here in a little bit. You're also going to need a copy of your mortgage note. That's something you would get at the time of closing, but a lot of people don't keep those. The best thing to do is to contact your lender to get a copy of all your signed documents because you're going to need that. You're going to have to get an updated homeowner's insurance information, which is super easy to do. You're going to have to get a title report, which typically what you can ask the lender to do is to reach out to whoever you use for your closing to get them an updated title report. A couple things with that. It's also if mortgage companies have their own title companies, they inflate those fees so they can make more money off of you. Don't want to do that. That's why if you go back to the people that originally did it, it's going to be a lot cheaper and the lender can use it. I mean, we do that all the time. And just a kind of a side note that I'm licensed in all 50 states to do mortgages. So if you guys need help, even if you're overseas and you have a home back stateside, please schedule an appointment with us. We're happy to help and go through that, right? So now we've covered a good amount of what an interest rate reduction refinance loan is. Now, when does it make sense, right? So the VA has put a couple of caps or let's say restrictions so veterans don't basically get equity stripped, right? Meaning like people keep refinancing you, charging all these fees. A lot of veterans just don't understand those fees and they just keep taking equity away, right? That's equity stripping. A lot of lenders did that a while ago and they got big fines for it. So they've stopped doing it. But the VA also has implemented things. So there's two things that need to meet the criteria, right? And this also, we're going to talk about, from a life perspective, does it make sense to refinance into the lower rates? So what you're going to need for the refinance to meet the criteria is that whatever your costs associated with the loan divided by 36 months, if you can recoup that cost, right, in the savings of your payment, within 36 months, you can do it. So let me use an example. Let's say by refinancing, you save $100 a month and your closing costs are $3,600. Well, per the VA, 100 into 36, 3,600 is 36 payments, right? So that basically means you'd be able to proceed with the refinance. Now, this doesn't include transfer taxes because Florida, you may not pay property taxes or state taxes, but you pay taxes on a refinance. Again, all of that should be in your determining factor because nobody really knows how low the rates are going to go, no matter how many predictions may be out there. It's just too hard to determine, right? A lot of people a couple years ago refinanced twice with these. You can use them as many times. You can do this program as many times as you like, right? The minimum amount of time you have to wait is 6 mortgage payments and 210 days from the first time you made a mortgage payment. So to give you an example, from October of last year through June of this year, right, which basically that's where a lot of the people purchase properties, those 230,571 transactions for veterans, and the average saving, which is about almost $82 billion worth of mortgages created, right? The average savings that we're seeing is about $354.17, right? So it can go more or it could be less, which is going to lead me into kind of like the following piece on that. One other thing on the criteria, it's the 36 months for recoupment, and the rate must be at least 0.5% lower. Which again, this kind of leads us into like, does it really make sense to refinance for 0.5%? So the numbers don't lie, right? That $356.17, if you're saving $354 a month, that's a great deal. But depends on how much the closing costs are going to be, right? If you're spending $15,000 to save $354 a month, that might not be a good deal, right? You might want to wait a little bit longer. Same thing if you have a lower balance loan. Nothing wrong with it. You did great. You bought a lower price point property. But if you're trying to refinance a $100,000 property and save even 1% or 1.5%, it's not going to make sense. The savings just won't be there. The higher your loan balance, the higher savings you have, right? So just imagine the average is 354. Half the people have above that and half the people are going to go below that. Where does it make sense? I think right now, if you're at 6.75 or higher, you bought before you closed in June or before that, you're going to be hitting the timeline for February. So think of it as like an early present to yourself for the year. and starting the new year off saving money, because that's the whole point of this. But just don't get duped. Nothing's free in life. You're going to have to pay for it one way or another. Even if a lender's giving you a credit to cover closing costs, they have to increase your rate because of that. So you want to be able to sit down, review your whole financial picture, and that's what's going to determine how everything else is going to flow for the transaction, right? If you guys are interested, please schedule a consultation with myself and my team. Hit the like and subscribe button. You have a good day.